Welcome as we take a look ahead to the week starting Monday the 16th of May. It follows Pentecost this weekend, so some of the European markets are out for the religious observance of Whit Monday. These markets that are out include the German, Austrian, Swiss, Norwegian and Danish markets. But IG will be making out-of-hours pricing on the Germany 30, the Norway 25 and the Swiss Blue Chip Index. So that's a quick wrap of some of the market moves next week. Let's take a look in some detail at some of the economic data that will be following next week. Let's take a look first of all at what's been happening or what's likely to happen on Monday. Rightmove House Price Index will give us an indication as to how much of the uplift in the markets we saw in the first quarter has been taken out as we go into the new tax year, which means that there's the culmination in George Osborne's tax changes for the housing sector as at the end of March. Now, Japan machine orders as well, Russia first quarter GDP. We've got a couple of bits of data out in the US. They're minor this week. New York Empire State Manufacturing and the NAHB Housing Market Index. Tuesday, RBA meeting minutes, Japan industrial production. We've got UK CPI, one of the big numbers out on Tuesday, and also Eurozone trade balance. Then later on, the US inflation data for the consumer price index, also industrial production and building permits. Wednesday, really focusing on the FOMC minutes, which comes after the close of the European markets. But in addition to that, we have the first quarter reading of Japanese GDP, Chinese house prices, UK jobs data as well as inflation in the Eurozone. On Thursday, again, Japan very much in evidence with machinery orders. We've got Australian unemployment rate and also the unemployment numbers as well in France, retail sales here in the UK and in the US, weekly jobless claims and the manufacturing survey from the Philly Fed. And to round off the week, Bank of Japan again back in the frame with the release of their most recent minutes of the meeting. Canadian inflation data out, including retail sales as well, US Chicago Fed and US existing home sales. Chris Beecham is with us now with some analysis of how to trade some of the data out next week. We were talking about what to go for because there's a broad spread of data out next week, but I guess really we had to pick out the Fed as one of the highlights because we've got that FOMC minutes out midweek and also consumer price inflation.
Plenty from the US next week, so enough to keep an eye on. But the Fed minutes, probably the big one, I think, where that's at least concerned, because, of course, they stood and held fire at their last meeting as we expected they would. And recent data really suggests that they'll continue to do so. Last week's non-farms were weaker than expected. We've had 3 consecutive weeks of increases in initial jobless claims. And while retail sales this afternoon have been stronger than expected, it's not really enough, I think, to suggest that actually we're moving in the right direction for a June rate hike. So you've seen the odds of that cut back once again, and the likelihood is that the minutes will reflect, I think, that caution. So you could start to see more weakness creeping in to the US dollar, and that's, I think, a key one to look at with the dollar index. You've seen it continuing to decline over the last few weeks, really. It's still in a longer term downtrend. You can see on that chart there. Rallies back towards the 50-day moving average, that descending blue line, certainly not doing particularly well at the moment. And the question will be now, if that is weak enough, will it start to send a new leg lower in the US dollar? And the corollary, of course, of a weaker US dollar is perhaps breathing room for equities, which have taken a beating over the last 2 weeks or so. Also, will oil prices continue to rally? That might be good news for markets as well. So in some ways we're hoping, or certainly some markets will be hoping, that you do have this slightly more dovish approach from the Fed. And if that's confirmed in these minutes, then you might start to see this dollar strength start to dissipate.
Yes, and of course, I say also we've got the inflation data out as well in the States. Also inflation here in the UK next week. Also got retail sales as well, and also jobless claims as well midweek.
It is, and again, a very busy week for UK data, of course, amplified by all the Brexit debate, which continues to rage. We've had Lagarde this morning warning about the consequences of a Brexit. You had Mark Carney yesterday, and obviously what he said about Brexit got a lot of focus, but also was the interesting point, if you looked at the inflation report, the forecasts they made for inflation and for growth were based on the idea that you'd only get one 25 basis point increase in interest rates in the UK by the second quarter of 2019, just the one over the next, say, 3 years. And that's quite an interesting statement to make, really. And that's probably why you've actually got quite a bit of weakness in the pound this morning. So I think it will take quite a bit to reverse course in the pound in terms of its trajectory. You've seen it pull back over the course of the month so far, down around about 200, 250 points from its highs right at the beginning of the month. I think for the pound, you'd need to see a move back above 144, 144.50 to really indicate that this pullback has run its course. But for the downside scenario is also quite limited, because you can see that you've got the 50 and the 100-day moving averages just below where we are now in the price. So there's quite a bit of support coming through in that sense that could limit downside progress. But if you do see it, I think if you get weaker data in terms of especially unemployment numbers, and if wage growth as well next week is weaker for the UK, then you'll start to see it maybe push back in the direction of that 140 low we had right at the beginning of April.
Yep. Okay, all right, let's take a look now at some of the corporate data out, and we can take a look in some detail at what's happening. First of all, on Monday, with some of the releases that we've got, British Land, the number of these property companies out with numbers this week, and in fact the two big ones, British Land heading up on Monday, Longmin as well, and Crest Nicholson out with the trading update for investors. On Tuesday, the big one there's Vodafone, but as I said, that property theme going through the week. Land Securities out with numbers as well. Premier Foods, Enterprise Inns, and Home Depot in the States coming through as a laggard, or one of the last of that quarterly inflation, a quarterly earnings number, I should say, from the States. SAB Miller, Burberry, SSE, the energy company, Rathbone Brothers as well out with numbers. Cisco, Staples, Lowe's, and Target on Wednesday. Let's look at what's happening on Thursday. Royal Mail Group heading up a relatively long list of stocks that are reporting here in the UK. National Grid, Britvic as well out with numbers. Investec, the South African bank. FTSE 250 property company Granger. Thomas Cook as well out with numbers. Hargreaves Lansdown, as well as a couple of US stocks as well to watch there, Walmart and Gap. And on Friday, Close Brothers, Campbell Soup, and Deere and Company. Chris, we looking at that list of companies there. I want to take a look, if I can, first of all, at one of the UK's largest companies, Vodafone. This business has pretty much completed Project Spring now, which I think many are hoping were going to be the big transformational strategic review of the company. And it certainly seems, according to some analysts, that it's looking as though it could produce some fruit, but not possibly immediately.
No, exactly. It's been quite a tough time for Vodafone, sort of rationalising its businesses for quite a long time. As you note, it's been a long process. A company the size of Vodafone takes a long time to turn around. Now, I suppose with Vodafone, the perennial question is what they do with the dividends. Will they continue to increase that? They recently said that they pledged to sustain the approach to progressive dividend policy, i.e. to keep raising them over the longer term. So with these numbers coming through this week, the question is, will you start to see an improvement in that, and will that give a bit of a boost to the share price? So in terms of Vodafone shares, if you bought them in at that low in February at £2 a share, and that's a rising trend line that you can see on the bottom there, that, if we look, zoom out, goes all the way back into 2012, 2013, and that was the dip at the beginning of this year, and since then the shares have rallied. But they've come off from that descending trend line we've got off the highs of last year. So Vodafone in this sort of longer term wedge formation. At the moment, the price just holding on around the 50-day moving average, the 50-day above the 200-day as well. So you can make a case for saying actually you might start to see a bit more strength, but it's not been the most enthusiastic reaction to the share price, and I think we could see the upside really capped by that descending trend line just above £2.30 a share, at least in the short term.
Yeah, okay. A second one worth looking at, I'm sure, will be Royal Mail Group. A lot of retail investors remain in this stock. I know it's quite a big favourite, and whenever it produces earnings, it makes some headlines in some of certainly the tabloid papers. Most notably, I guess, possibly around the fact that letters seem to be a dying part of our culture, really. And it was at one point very big for Royal Mail, but parcels now make up a lion's share of the business. And
continue to do so, really. But the problem is that other parcel delivery firms, the likes of Amazon, continue to eat away at some of Royal Mail's business, and they still labour under this requirement. They have to deliver to every part of the UK. So while they're officially an independent company away from the state, they still have these sort of hangovers from its previous existence as a ward of the state, if you like. We're looking to see, and again, improvement in terms of the payouts, because Royal Mail, one of its attractions has been that dividend payout. at about 12 times forward earnings. It's not too expensive, and certainly has done very, very well in common with the broader market since that low in February. It seems like we repeat what we said with Vodafone, that you've had a fantastic performance. Although if you'd stepped in those February lows, you'd have done fantastically well, but it required a bit of a leap of faith, as so many things did in February. So even now, even at just 12 times forward earnings, the question is now, is the good news in the price? Are we seeing that unwind? And a lot of people maybe bought Royal Mail in expectation of these earnings, and now you can start to see them sell off, just as you have, by the way, with sort of the likes of Tesco and RBS this year. Both of those had good run-ups into their full year earnings, and then they've sold off heavily. So the risk is, I suppose, with Royal Mail is that a lot of this gain now starts to be unwound. Yeah,
you talked there about the lows we saw in February. Much of that was generated by the big drop that we saw in the Chinese markets, of course. And I know the third stock you want to talk about is Burberry, which is, I won't say heavily dependent on China, but a lot of the expectations have been wrapped up in the enthusiasm that the Chinese have for these Western labels, and Burberry is amongst them. And of course, we now know that China is beginning to cool on this sort of thing, and this is one of the first things that goes, of course, when you get any pain in the economy. People stop buying luxury brands such as Burberry.
Yeah. Burberry was two things. Burberry was a China stock, as in years past, and it was also a growth stock in a sort of its most purest form, if you like. Burberry had a terrible 2015 in share price terms, because if you were pivoted to China and you saw weakness in the Chinese economy, then you expected, as you said, people to continue to cut expenditure. And so the share price just kept heading lower. It's one of those trends that you would give your right arm for if you can stay on board. Every time it bounces, you sell it again. It stays below the 50-day moving average. One tiny bounce in October, but again, that was just yet another selling opportunity. Has that come to an end? Maybe we thought so. In March, we were back up at almost £15 a share, but then we've sold off incredibly since then. Is this just the beginning of a new leg down for Burberry shares? If we do continue lower, and if there's no good news in the numbers coming through next week, then we were looking at that £11 a share mark just below where we are, and then really continuation risks all the way down to about £10 and 50 pence a share in the short term at least. That's your big support level we'd be watching. If that goes in the weeks to come, then we could see a very ugly unwind in Burberry's share price.
Yep. OK, Chris, thanks so much indeed. I think in terms of the figures there for Burberry, we're looking at something around about a 6% drop in the figures we're due next week for the year, down at around £405 million for the pre-tax. That's it for our look ahead to the week starting May the 16th.